You're watching Jon Ag Briefing, the desk that does not run on advertiser money, the desk that does not soften the data because it makes you uncomfortable. Spot silver is trading near $65.56 as I record. That is the price. What I am about to walk you through is not. Stay with me. The Federal Reserve met on the 16th and 17th of June 2026. It was the first meeting chaired by Kevin Warsh, who took the role after Jerome Powell's term expired on the 15th of May. The committee held the federal funds rate at 3.50 to 3.75%. That decision was already priced in. What was not fully priced in was the tone. Governor Stephen Miran dissented at the March meeting in favor of a cut. 4 governors dissented in April. The split inside the committee is real and it is growing. The next data point lands on the 25th of June 2026, when the Personal Consumption Expenditures Inflation Report is released. Core inflation ran at 2.9% in May, according to the Bureau of Labor Statistics, while headline inflation sat near 4.2%. That gap is the entire argument. If the Fed treats energy-driven inflation as temporary, real yields compress and silver benefits. If Warsh signals it is structural, the cap holds. After the PCE print comes the non-farm payrolls report on the 2nd of July. After that, the next full FOMC meeting is the 28th and 29th of July, the first since the leadership transition to carry a complete press cycle without the shadow of confirmation politics behind it. The first cliffhanger is this. The Fed chair, who just took the seat, has not yet shown his hand on whether war-driven inflation gets treated as noise or as a new baseline. Stay with me. The World Silver Survey 2026, published by Metals. Focus on behalf of the Silver Institute puts the 2026 global silver deficit at 46.3 million ounces. That marks the 6th consecutive year the market has consumed more silver than it has mined. 6 years running. Not 1 year of surplus to offset it. The structural reason supply cannot respond is simple, and it is rarely explained on camera. Between 70 and 80% of global silver output comes as a byproduct of mining lead, zinc, and copper. Miners are not digging for silver. They are digging for base metals, and silver comes out the side door. That means a higher silver price does not trigger new silver mines the way a higher oil price triggers new oil wells. It triggers nothing because the decision to open a base metal mine is made on the base metal price, not on silver. S&P Global's mine cost outlook projected the global weighted average all-in sustaining cost for silver would rise 3.8% to $23.44 per ounce in 2026, and that estimate was published before Brent crude pushed above $100 a barrel earlier this year. Every dollar of additional diesel cost raises extraction costs across that 70 to 80% of supply that cannot simply decide to produce more. The second cliffhanger is this. The deficit is not a one-year anomaly, it is a 6th straight year, and the supply side has no mechanical way to close the gap quickly. Stay with me. Fresnillo plc, the world's largest primary silver producer, cut its 2026 production guidance to a range of 42 to 46.5 million ounces. That is a 9% reduction from prior guidance. Hecla Mining and First Majestic Silver have both guided lower as well this year. Mexico, which represents roughly 25% of global silver supply, remains under a government moratorium on new mining concessions, meaning the largest single-producing country cannot bring new ounces online even if it wanted to. On the other side of the ledger, Wheaton Precious Metals closed a $4.3 billion silver streaming agreement with BHP Group on the 1st of April 2026, covering the Antamina mine in Peru. Under that deal, Wheaton locks in BHP's silver production at 20% of the spot price, the largest streaming transaction of its kind on record. When the world's largest diversified mining company agrees to hand over decades of silver production at a fifth of market price, just to guarantee a counterparty has physical metal under contract. That is not a bullish opinion. That is a balance sheet decision made by people with no incentive to be wrong. The third cliffhanger is this. The largest primary producer on Earth just told the market it is making less, while the largest diversified miner just paid to lock down what it has. Stay with me. Here's where the data gets contested, and this desk is not going to pretend it is clean. As of the 11th of June 2026, COMEX registered silver inventory stood at approximately 82 million ounces, according to CME Group warehouse data. July contract open interest on the same date sat near 268 million ounces, or roughly 53 to 3,600 contracts. Divide those two numbers and the coverage ratio comes out near 30.6%. A separate live tracking dashboard, also pulling from CME Group's daily metal stocks report, puts the same coverage ratio at 16.0%, with paper leverage running at 6.2 times deliverable supply. Both claim to use exchange-published numbers. Both cannot be fully right at the same time, and that gap alone tells you something about how murky physical versus paper accounting has become at the exchange level. What both trackers agree on is the threshold. Anything below 15% is defined by exchange analysts as stress territory, and one tracker says the market has already crossed it, while the other says it sits just above the line. Separately, the premium for silver on the Shanghai Futures Exchange over COMEX has run between 12 and 13% earlier this year, a sign that physical buyers in China are paying up rather than wait. The fourth cliffhanger is this. Two data sources pulling from the same exchange cannot agree whether the physical buffer is tight or critical, and that disagreement is itself the story. Stay with me. China's silver imports reached their highest level in 8 years in early 2026, according to trade data cited by finance magnates. That is industrial and investment demand arriving at the same time the SHFE premium was widening, which is consistent rather than coincidental. In India, a regulatory shift opened a new institutional allocation channel for silver exchange-traded funds, with one industry estimate putting the addressable pool at $970 billion. At just 1% adoption of that pool, the implied new demand is roughly 34 million ounces, close to 3/4 of the entire 2026 structural deficit on its own. At 3% adoption, new demand from that single channel would exceed the entire annual deficit. These are not retail trading flows. They are structural allocation decisions inside large institutions that move slowly and rarely reverse once started. The fifth cliffhanger is this. A new institutional buying channel just opened in the world's largest physical silver market, and even modest uptake rivals the entire global deficit. Stay with me. The BHP Wheaton streaming transaction is not only a producer story, it is a pricing architecture story. When the largest diversified miner on the planet structures a $4.3 billion deal pricing silver at a fixed 20% of spot rather than transacting on the open market, it signals that even the biggest players are routing meaningful volume around the COMEX price discovery mechanism entirely. Separately, Mexico's standing moratorium on new mining concessions functions as a de facto supply floor mechanism, holding back 1/4 of global production regardless of what price signals say. Neither of these is a government press release calling itself a price floor. Both function as one in practice. The sixth cliffhanger is this. Significant volumes of physical silver are now being priced and allocated outside the mechanism that sets the headline number you see on a screen. Stay with me. Wall Street's own targets for silver in 2026 do not agree with each other, and the gap is wide enough to matter. JP Morgan's average price target sits near $81. A Reuters poll of analysts published in February put the average 2026 target at $79.50, though that same poll's average was just $50 as recently as October of last year. Citigroup, in a forecast published on the 29th of January, set a target range of $150 to $170, with strategists calling silver gold on steroids. Bank of America's Michael Widmer has published a target range of $135 to $309, built on a thesis of gold-to-silver ratio compression. The distance between JP Morgan's $81 and Bank of America's high case of $309 is not a rounding error. It is roughly a 4-fold spread on the same metal, the same year, from two of the largest banks on Wall Street. The seventh cliffhanger is this. The professional forecasting community is more divided on silver's direction right now than at almost any point in recent memory. Stay with me. The single largest unresolved catalyst sits in plain sight and most coverage is skipping past it. The Personal Consumption Expenditures Report lands on the 25th of June 2026, 4 days from now as this is recorded. That number, more than any single headline this month, will tell the market whether Kevin Warsh's Federal Reserve treats the current inflation run as a temporary artifact of the Iran-related oil spike, or as a structural problem requiring a tighter stance through year-end. A hawkish, raid pressure's real yields higher and caps silver in the near term, regardless of the physical tightness underneath. A dovish read does the opposite, and it does it fast, because positioning across gold and silver has been whipsawing on every Fed signal for months. The eighth cliffhanger is this. A single inflation print in 4 days may matter more to silver's next move than every supply data point in this script combined. Pay attention. Here is the bearish counterargument. This desk gives it in every script, and today is no different. Silver has already corrected hard, falling from an all-time high of $121.62 on the 29th of January 2026 to a low near $63 and 90 cents on the 6th of February, a drawdown of close to 48% in 8 days. Recent price action shows continued weakness, with silver down roughly 14.4% over the past month as of the 19th of June. 9 of the Fed's 19 policymakers now expect at least one additional rate hike this year, not a cut, and markets are pricing close to a 70% probability of a hike by September. A stronger dollar, driven by that same hawkish positioning, directly pressures silver. The Reuters poll's prior average of just $50, set as recently as October 2025, shows how quickly consensus estimates can swing in either direction and how unreliable any single target should be treated. The recent COMEX inventory build of 4.8 million ounces between the 21st of May and the 1st of June shows the system can add deliverable metal when delivery cycles demand it, undercutting the narrative of an irreversible physical shortage. Indian gold ETFs recorded their first net monthly outflow since April 2285 in May, with gross redemptions of roughly $348 million. A reminder that institutional allocation flows into precious metals are not one-directional even when structural cases sound compelling. And a ceasefire in the Iran conflict, if it holds, removes the single largest geopolitical risk premium baked into both oil and precious metals, pricing since late February. The bear case is real. I'm not softening it. Here's what the structural data says as of the 21st of June 2026. Silver spot price $65.56, June 20th, 2026, JM Bullion. All-time high $121.62, January 29th, 2026. Correction low, $63.90, February 6, 2026. 1 month price change, down 14.43%. As of June 19th, 2026, trading economics. Gold to silver ratio, 64.8, June 19th, 2026. Use of gold, Fed funds rate, held at 350 to 3.75%, June 17th, 2026, FOMC decision. Next PCE inflation report, June 25th, 2026. Next non-farm payrolls report, July 10th, 2026. Next FOMC meeting, July 28 to 29, 2026. 2026 global silver deficit forecast. 46.3 million ounces, World Silver Survey. 2026, Metals Focus and the Silver Institute. Consecutive years of deficit, 6. Fresnillo 2026 guidance cut. 42 to 46.5 million ounces, down 9%. Wheaton BHP streaming deal, $4.3 billion closed, April 4th, 2026, Antamina mine. COMEX registered silver inventory, approximately 82 million ounces, June 11th, 2026, CME Group. COMEX coverage ratio reported between 16.0 and 30.6%, depending on source, June 2026. JP Morgan 2026 average target, $81. Citigroup 2026 target range, $150 to $170, published January 29th, 2026. Bank of America 2026 target range, $135 to $309, Michael Widmer. This is Jon Ag Briefing. The desk does not run on advertiser money. The desk does not soften the data because the headline reads better the other way. Every number in this script has a primary source. Federal Reserve, Bureau of Labor Statistics, CME Group, World Silver Survey. 2026, Metals Focus and the Silver Institute. Fresnillo PLC, Wheaton Precious Metals, JP Morgan, Citigroup, Bank of America, Trading Economics, Use A Gold, JM Bullion, Reuters. Pull every one of them, verify them yourself. That is the entire point of this channel. The Fed faces a PCE print in 4 days that could decide silver's next leg. 6 straight years of deficit just got confirmed at 46.3 million ounces. The world's largest primary producer just cut output while the world's largest diversified miner paid $4.3 billion to lock down supply. Wall Street can't agree whether silver is worth $81 or $309. This is Jon Ag Briefing. Verify everything. See you in the next one.